this learning objective, we discussed the different kinds of managed fund investment vehicles that operate across Australia. So the basic idea behind all types of funds is the same. That is, funds tend to pool capital together amongst a whole lot of users and take that pooled capital and go invest it somewhere to the benefit of the suppliers of the capital. So this is generally achieved by being a provider of funds in the market. So for example, by buying a whole lot of financial assets, which can be either in the primary market or in the secondary market. So in the primary market, for example, would be a venture capitalist trust, which is a trust that's set up to buy a whole lot of shares through buying companies. And secondary market might be buying and selling a whole range of assets, including shares, bonds, or alternative assets. The key benefit of funds is that they provide diversification and divisibility. So this means that for a relatively small amount of money, you're able to diversify across a lot broader range of assets than might otherwise be possible with that amount of capital. And also divisibility in that the process of securitization takes large assets, and when they're invested in a fund, because of the process of units being created through that securitization, the returns on that asset is basically divvied up across a large range of different investors, such that investors are in effect buying a small divisible component of the big asset. Funds can also be beneficial because the pooling of capital can result in a pooling and reduction of transaction costs, and you can also take advantage of professional management and record keeping. So the key types of funds that we see in existence in Australia are those listed in the screen. We've got insurance funds, superannuation, various unit trusts and managed funds, real estate investment trusts, exchange traded funds, and hedge funds. And across the course of this lecture, we discuss each of these different types of funds and talk about some of their benefits. So if we plot the assets under management of these different types of funds in Australia through time, we can see that while there does appear to be some growth across all the different fund types, the largest growth, and by far and away the largest source of funds under management in Australia, in the Australian market, are superannuation funds. So since superannuation became compulsory in Australia, we've seen this exponential growth taking place. This decline here is because of a decrease in the value of the assets being managed as a result of the global financial crisis. But other than that GFC period, this continual upward trend, such that a really large proportion of total funds under management is within that sector. So discussing each of the different types of the funds briefly. First of all, insurance funds. Insurance funds are a pooling of funds together that are contributed to the insurance company. And the idea is that the providers of the funds are paying premiums to be insured against some pre-specified event. Now, the insurance company will take the money that they receive from those premiums and invest them for a period of time. The assets that they invest in will depend on their liquidity needs. So we tend to find general insurance companies that insure against motor vehicle, home and property, travel and other related type events. They tend to have more unpredictable and short-term needs for capital, so they'll invest in more liquid assets. Whereas life insurance funds tend to have more predictable payouts and longer-term investments, so they'll invest in higher risk assets that have less liquidity and often longer terms of maturity. Now, when these assets are invested, the legal ownership of the assets that's held is with the insurance company themselves, and the insurance company will then have individual contracts with each of the ultimate beneficiaries who are the insurance holders. The insurance companies, when they do go about investing, they try to invest as a way to hedge against their liabilities. So they try to make sure that the duration and the risk of their investments is matched against the equivalent payouts that they may have to make across the future. A second type of fund that we see in Australia, and as we spoke about earlier, this is the most dominant type of fund in the Australian market, are superannuation funds. Across the world, these are also known as pension funds. And basically, this is just a pooling of funds together that's contributed towards some retirement scheme with the view that each of the fund unit holders will be investing some money to fund their lifestyle once they're finished in the workplace. With superannuation funds, there are two basic types of plans. First of all, a defined benefit plan is a plan where the amount that the superannuation fund unit holder is paid at their retirement is a function of some formula. That formula is usually modelled using their final years of salary, their years of employment, and potentially other variables like their age. So in that particular case, for defined benefit, the return you get does not depend on market forces. The second type of superannuation is a defined contribution plan. This is where an investor puts in a particular amount of money on a regular basis, and the amount available to them at retirement is the amount they've contributed plus or minus any capital gains or losses that accrued on the account across the period of their investment. Now, as we saw earlier, superannuation has grown significantly in Australia in terms of funds under management over the last 30 years, and there is a good reason for this. Since the 1st of July 2002, employers have had to contribute a minimum of 9% of their employees' earnings to a superannuation fund, and this minimum contribution, known as the superannuation guarantee, is actually slated to increase up to a level of 12% by 2020. So the amount of superannuation assets under management is only expected to grow into the future, and hence superannuation funds are the most dominant form of investors across Australian financial markets. Next group of companies are unit investment trusts. Unit investment trusts are pools of funds that invest in a portfolio that is fixed for the life of the fund. So a unit trust is generally formed by some sponsor, and often the sponsor will be a brokerage firm, who buy a portfolio of securities that are then deposited within the trust. So that bundle of securities might, for example, be a portfolio of shares. And once that bundle of securities is held together within the trust, a range of units are then created with the trust, where each unit has a pro rata right to the cash flows of the trust, and the units are sold to investors. All the income from the portfolio is paid out to the unit holders in proportion to the number of units that they own. But the key aspect of a unit investment trust is it does not tend to be actively managed. So it tends to be that there's the initial portfolio that's constructed up front, and that same portfolio will be passively held across time, thereby decreasing fees. But unit investment trusts have declined in popularity compared with other fund management structures across time. The reason they've declined in popularity is because on one hand, you don't get the benefit of active management, whereas on the second hand, there's actually cheaper ways to access investments in passive portfolios. These are known as exchange-traded funds. Hence, basically, there's not really much of a role for a unit investment trust anymore. Now, one thing we do know about unit investment trusts is that they may liquidate their investment by selling their units. Investors may liquidate their investment by selling their units back to the trust at net asset value. This is a really key concept because net asset value and this redemption process is how funds differ from each other. So net asset value is calculated as the market value of assets in the fund less the liabilities divided by shares outstanding, and that's giving you the market value of each unit. The majority of funds calculate net asset value as at the end of the day. So what this means is that if you decide, in the course of one day, you want to redeem your units, you want to sell your units back to the fund, then the value that you receive will be the net asset value as at day's end. So unlike shares that are traded on an exchange, where you can buy and sell at any instance, in effect, this process of calculating net asset value means that you can only redeem your units on a daily basis. Now, unit trusts can be either listed or unlisted. Both types exist. And the trustee may either sell part of the portfolio to fund redemption of units when an investor does decide to redeem, or they may wish to on-sell those units to another investor, thereby keeping the same amount invested in the portfolio. An alternative to a unit investment trust is a managed investment company. A managed investment company is a fund where you have a manager providing oversight to the fund, and because you've got that professional management, they'll generally charge an annual fee that ranges between 20 basis points and 150 basis points per annum. There's two key types of managed investment companies, and they're open-ended funds and closed-ended funds. So open-ended funds, first of all, they issue and redeem shares in the fund at net asset value. So basically this means that the size of the fund itself can expand and contract across time as either investors seek to purchase more units in the fund or as investors redeem their units and wish to sell back to the fund. There are some open-ended funds that trade on the Australian Securities Exchange, and these are known as listed investment trusts. On the other hand, closed-end funds have the same amount invested within their portfolio across the life of the fund. Apart from the initial public offering, they do not issue shares and do not redeem shares. Therefore, if an investor in a closed-end fund wants to liquidate their position, they generally need to go and sell to another investor. Managed investment companies in the form of closed-end funds also might trade on an exchange, and the market price should closely match the net asset value, although it's often been observed that these often trade at a price that's below their net asset value, which is known as the closed-end fund discount, and is often pointed to be a criticism of the efficient market hypothesis because the price doesn't appear to equal to fair value. Another form of fund is a real estate investment trust. So these are trusts, again, like those that we spoke about previously. The key difference here being the underlying assets are real estate assets. So there's a portfolio, which is a bundle of real estate assets that are put together, and then they're securitized, a whole lot of units are created, and those units are sold off to investors. On the Australian market, real estate investment trusts are often abbreviated with the name AREITs. Finally, and quite importantly because of their growth in popularity over recent times, are exchange-traded funds. So exchange-traded funds are investment funds, but they differ because they trade on the exchange just like a stock. The exchange-traded fund itself will invest in a basket of securities and, again, create units over those securities. And they exist for a wide range of asset classes, including equities, debts, currencies, and commodities. So they're an effective way for investors to get access to a range of different asset classes, while also having a high level of liquidity because these do trade like a stock on the market, and relatively low transaction costs because you don't have the high management fees that managed investment trusts have that we spoke about earlier. Exchange-traded funds tend to be open-ended funds in form, in that the number of units may increase or decrease in response to demand and supply. So, for example, if an institutional investor decides that they would like more units in a particular ETF, often what will happen is the ETF sponsor will simply go out, expand their portfolio to create new units, and then go and sell those units to the institutional investor. So that's a range of different types of funds that exist within the Australian market.